Hi, thanks so much for tuning in. You're watching the Mutual Fund Show on NDTV Profit, and I'm Alex Matthew. This show gets you actionable insight on everything mutual fund related, whether it's deciding your overarching strategy or reviewing whether you're invested in the right schemes. On today's program, we'll start with a chat on Edelweiss Mutual Fund's latest offering, which is a tech fund. We'll discuss how they're planning their portfolio strategy and what the objective is. We'll also then delve a little deeper into strategies or mutual fund schemes that invest overseas or in equity options or stocks overseas. There are regulatory restrictions in place, so which schemes should you look at and what are the strategies that you should pay attention to? We're joined at the start by Trideep Bhattacharya, who's the CIO of equities at Edelweiss MF. Trideep, thanks so much for taking the time and pleasure speaking with you as always. Your NFO starts today. Talk us through the idea behind it and we'll delve a little deeper into the planned portfolio construction then.
Sure. First of all, thanks for having me in your very popular show. I would say that overall, one of our thesis or thinking right now is that the global growth actually will bottom out this year and will rebound next year. And as a play on rebound globally next year, this year could be a good year to accumulate thematic portfolios like technology, which is ultimately a play on global earnings. When we think about technology, we obviously think about technology in the Indian context in a broader way, which is Indian IT services companies and also the new age companies. And we also combine this with some of the global tech leaders to get access to those technologies like AI and a few others, which are mostly on the B2C domain and not available in India. So as a concoction, the fund that we are talking about in the form of Edelweiss Technology Fund gives investors an exposure to not only Indian IT services plus the newest technology companies, but also global industry leaders. And hopefully that is positive from an investor portfolio standpoint over time, both cyclically, given the global rebound that we think might happen next year, and also structurally, as technology penetration across different industries is growing rapidly and will likely grow even further going forward.
Now, when we get into the construction or the proposed construction of this portfolio, Trideep, as I understand it, it's going to be 70 to 80% Indian stocks and 20 to 30% foreign stocks and within the S&P 500 universe. How is this going to work? How is this dynamic going to work?
I think basically the 70-30 mix is just about the right one. And the reason I say so is, keeping it, of course, within 30% or within 35% gets us the equity taxation. And hence, that is beneficial from investor standpoint. Secondly, I mean, overall, if you look at while Indian companies are mostly B2B dominated, our customers are mostly businesses. The US technologies, which is now US technology stocks, which are mostly seen as a proxy for the rest of the world tech, are mostly B2C dominated. So this combination of 70-30, call it, gives the investor a right mix of B2B and B2C, right mix of India as well as global, and just about serves right from the taxation perspective. So that's the best that we could package in one fund.
Now, if I look at the themes that would fall under tech, it's quite wide-ranging, all the way from generative AI to fabricators. I'm talking about semiconductors and chip designers as well. And all of those are themes, Trideep, that have run very well over the last several months. The question is, we're launching now and we're looking at a fund that is looking to benefit from these developing themes. The question that some people will ask is that potential currently in the price? And are we buying at elevated valuations?
I think, good question. So I will say that overall, first of all, the economic situation in the United States or globally is not particularly great. We all know that. And hence, tech as a play on global earnings, particularly from a B2B standpoint, hasn't really done well. So if you look at, for instance, the Indian tech sector, right, it has underperformed the broader market by at least close to about 20% over the last couple of years. And that makes the starting valuations for Indian companies or tech companies overall in general, relative to their own 10-year average, reasonably attractive. That's number one. The second point I would say that overall from a global standpoint, some of the trends that we are talking about, like you mentioned, artificial intelligence, robotics, Internet of Things, and likewise, these are actually decadal themes. They don't go away in 1 or 2 years. And hence, I would suggest that these would they are more structural in nature than otherwise. And hence, taking an exposure to these themes would actually benefit investors over a long period of time. And we are suggesting those investors to invest in this fund who have an outlook for about 5 to 10 years. So I would actually think this serves a very good purpose for investors who want to take exposure to Indian IT services, Indian technology names, which have lagged the broader market and have still decent valuation support. And at the same time, want exposure to some of the global technologies like artificial intelligence, robotics, IoT, which have a shelf life of at least more than 10 years and are more structural in nature.
Understood.
So I think we're just about at the right time, if you ask me.
No, and it's an important clarification to make, because I think a lot of people, Tridib, jump into tech or rather thematic funds in general, thinking that they can ride the wave of something that is playing out and make a quick buck. But then what you're saying is that this is a theme that you anticipate will play out over the long term, and so you should have a 5+ year time horizon. And it's important to make that clarification. I also want to understand, there are restrictions that are in place currently for the industry with regard to investing in overseas equities. How is that going to constrain you, if at all?
So at some size, probably, it probably does. So the starting point is, at the moment, with regards to our own overseas offerings, and likewise, we do have space within the industry prescription, which is within the limits of what we have already invested, given the redemptions that the other in some of the other places. So we have a bit of space within our existing limit to participate globally. And mind you, the global component is just about 20 to 30%. So from a overall fund standpoint, we can scale up meaningfully before even thinking about violating or hitting those constraints overall.
Understood.
So on net balance, we are not worried about that.
Understood. I'm just trying to understand how far you will go. Now, you've said US S&P 500, which is in fact quite a large universe just as it is. Are you restricting yourself at all to the very large players? And we're talking about something like an Apple, and I'm sure that some of my viewers are aware of this. You would look at the market capitalization and say, hey, you know what, the Indian stock market is comparable. So therefore, are you looking at the very large companies, or are you willing to go broader as well?
So I think it's a good question. And the first thing is what we are looking to do in taking exposure to US stocks is using US as a proxy for global technology. That's the first point that I would make. If you look at Indian technology companies, they operate at one subsegment of tech, which is or mostly operate in one segment of tech, which is IT services. The other areas like semiconductors, hardware, components, AI, and areas like these, which are more B2C in nature, are not available in India. And that's what we are looking to explore. That would be the second part that I would highlight. The third I would highlight is that when we are looking at S&P 500, it is mostly the universe that we are talking about, that the universe is S&P 500. Actually, within the S&P 500, we are looking at companies which fall under technology domain. And within that, we are probably going to limit ourselves to the top 50 names. So yes, we would be kind of looking at the larger cap names overall in the global scheme of things. But at the same time, those are the guys who are benefiting disproportionately from the emerging trends, because the big gets bigger, particularly in the context of technology. And I mean, one can only look at how Amazon has grown or how some of the other global names have actually grown over a period of time. And these are just examples, not stock recommendations. But net, the US component would be managed in a more rule-based manner, as you are showcasing. It will be rebalanced on a quarterly basis, but it will be the subcomponent of technology part of S&P 500. So it will include some large caps or some mega caps, some large caps, but certainly not global small caps or thereabouts. It will be the larger caps ones which will be exposed to.
Understood. Trideep, the last question, and that relates to the timing. We're speaking on a day when we've just had the CPI print in the US. It is not what people had anticipated, to say the very least, and you've seen a reaction across the board in risk assets. The question is, if we do have the rate cuts now pushed down the road, one would only assume that the landscape for at least the Indian IT services does not look too rosy for the next three to 4 months or thereabouts, at least half a year, right? Is that something that you're factoring in? Is that a risk that you need to bear in mind?
I won't say so. One of the golden rules in investing is invest when there is a famine outside, and take profits if there is a feast all across. So when global data points are contrary to the fundamentals, you get share prices which are available at valuations which are worth looking at. And I would agree with you that overall in the very near term, i.e. 3 to 6 months, we don't think that the fundamentals will change dramatically in the positive direction. And hence I said that overall, we think that this year, calendar year 24, is a year when investors should gradually accumulate exposure to this sector via our fund, because we think come CY25, the next calendar year, you would start seeing recovery coming through, and as a play on that, things would improve. So yes, delaying of rate rate cuts does sort of delay the immediate improvement, so to speak. But then that's when you get the best valuations to invest from a share price standpoint, which is the seed for future returns for investors over time.
I'm glad that you said that. Thanks so much, Trideep, for joining us and for having this conversation with us. Pleasure speaking with you.
Thank you very much.
All right, viewers, we have to slip into a very quick break. But on the other side, we're going to talk about how this particular scheme and indeed thematic schemes fit into the ambit for you. And we'll also talk about wider strategy if you want to invest in stocks overseas through the MF route. Do stay tuned.